level is sustainable. But when you get up to 60%, 60% happens to be the level under the Maastricht Treaty where the members of the European Union are not supposed to have debt in excess of 60% of their GDP. Now, many of them do. I'm not saying this is a hard and fast rule, but that's where Angela Merkel gets a little bit upset when you're above 60%. And Spain and France and some other, Italy certainly are above that threshold. But there's another threshold that's important, which is 90%. And 90% comes out of the research of Ken Rogoff and Carmen Reinhart. And what they've shown in developing markets, developed markets throughout the 20th century, recently in the distant past, no matter where they look, once a country gets above 90% debt to GDP, a couple things happen. Number one, debt is no longer productive. The idea of borrowing is I'll borrow a dollar.
Dude, I'm going to do something with that money. Huh?
Yeah, I'll borrow the dollar, I'll spend the dollar, but I'll get $1.20 of GDP because, I'll spend it on something, but then the recipient, he'll spend it, and then someone else will spend it. And by what's called velocity, or the turnover of money, you'll actually get more than you borrow. That's Keynesian economics, very simplified version of it. But what Rogoff and Reinhardt have shown is once you get past 90%, that's no longer true. You borrow a dollar and you spend a dollar, but you might only get 90 cents or 80 cents of GDP. In other words, you reach a point where you cannot borrow your way out of debt. You cannot borrow your way to get enough productivity to get out of debt. And then you're sort of in a doom loop or a death spiral. Well, I mentioned 30% is comfortable, 60% is a problem in Europe, 90% is this critical threshold. The United States today is at 106%, but we are very rapidly moving to 120%. When you take the additional $5 trillion of new deficit spending that the Congress has approved and put that on top, and bear in mind, the GDP has gone down, right? So your denominator is shrinking, your numerator is going up, which means the fraction is going up, and now the debt is well in excess of 100%. It's actually coming into 120%. So all of a sudden, the United States starts to look like Italy, or for that matter, Lebanon or Japan, which is the highest of all. Now, the modern monetary theorists, MMT, modern monetary theory, whom I completely disagree with. I know a lot of them. I know Stephanie Kelton. She's a big brain. She's one of the thought leaders. She has a new book coming out. They say, so what? They say it doesn't matter. That you can take your debt to GDP ratio to not only 100%, but 200%, or in theory, even 300%. It just doesn't matter for two reasons. Number one, you can always print the money to pay off the debt. By the way, everything I'm talking about does not apply if you're borrowing in a different currency. If you're Argentina and you print pesos, but you're borrowing in dollars, that's a problem because you can't print dollars. But of course, the United States can print dollars. The ECB can print euros. Bank of Japan can print yen. And if that's the currency of your debt, just print up the money. What's the problem? And they have other solutions. If inflation starts to take off, just raise taxes. I'm not so sure about that. You borrow yourself into oblivion and you get inflation and you think you can tax your way out of it. That doesn't sound like a very good way to go. But the bottom line is that all the countries, starting with the United States, but all the major developed countries, are now in these sky high and rising debt to GDP ratios. Now, the question is, what's going to happen next? Interest rates are extremely low. The central banks have made them low. So the debt service is not that great. The debt is huge. But if you're only paying, a fraction of 1%, it's not as if you're incurring a lot of interest expense, which of course adds to the deficit. So that's the first thing. We don't have inflation. People who say that, the money printing that the central banks are doing to buy the debt, which they are, is inflationary. That's not true. That's a kind of gross misunderstanding. Comes out of Milton Friedman, et cetera. It's not true. What does cause inflation is velocity, which is the turnover of money. People lose confidence in money, and they spend it, and someone else gets it and they spend it. Everyone's spending it because they want to run into hard assets, land, gold, silver, fine art, real estate, et cetera, or just buy a car because they think the price is going up, or a refrigerator, whatever it is. If you get that kind of velocity, inflation can happen very quickly. And we saw this in the late 1970s. So the real warning is not that any of these countries are going to default on their debt. They're not going to default on their debt because they can print the money. The danger is inflation. Now, if you said, do I see inflation right now? Absolutely not. We're going to see deflation, which is a different kind of danger. Deflation causes debt defaults
Well,
because
Japan has been trapped into that like for 30 years.
yeah, and Japan's been in a depression, in my view, since 1990. My view, the U.S. has been in a depression since 2007. We're in our second lost decade. Japan's entering their fourth lost decade. But it's as if all the countries in the world are getting more and more like Japan. I had a meeting with Saki Kabara-san. He was very famous in the 1980s. He was known as Mr. Yen. He was an assistant finance minister in Japan, but he was called Mr. Yen. But very smart guy, very nice guy. And I confronted him on this. I said, Saki Kabara-san, your debt keeps going up and your debt to GDP ratio is sky high, and your GDP is kind of flat. And he said, yes, but you're missing one thing. He said, our population is going down, which is true. So on an overall basis, they're flat, but on a per capita basis, their GDP is actually outperforming. So I said, so the logic of that is someday there'll be one person left in Japan and she will own the entire country and be the richest person in the world. Well, it's very bad for Argentina, and here's why. If you, or Chile for that matter, if you borrow in dollars, and then we have deflation, what does that mean? It means the value of cash is going up, but it also means the value of the debt is going up. So even if you have very low interest rates, which we do, when you borrow in dollars and the dollar is worth more, that's what deflation is. Your dollar is worth more. That means your debt is also worth more, meaning you owe more debt in real terms. The nominal debt's the same. So if you borrow 100 million, you owe 100 million. That doesn't change. But if you have deflation, so that the 100 million is actually more valuable. See, this hasn't happened since the 1930s. People don't understand. No one alive has really lived through a strong deflationary period. A lot of us have experience with inflation. We had it in the United States in the late 70s, and you're right, Argentina's had it on multiple occasions, and we can name other countries. People have a sense of what to do in inflation, but no one alive has experienced serious deflation since the 1930s, and if you did, you're 95 years old today. So people don't really understand it. But one of the things it does, it makes the real value of debt go up. So in real terms, you owe more money. So if you were in trouble to begin with and you borrowed money to get out of trouble, but the value of the debt goes up, now you owe more money. Now where do you stand? It may not show up in interest payments, but every dollar becomes more and more difficult to get. The dollar's worth more. So what it means is that you see a strong dollar. Now, your local currency could be weaker against the dollar. That's true. That could help exports. It could help tourism. So,
there's no tourism right now. There's not going to be more tourism.
Well, you make a good point. There is no tourism today. I'm on a mountain, and you're in a home or studio or someplace. So right, there's no tourism going on today. But assuming it comes back next year, if you have a really strong dollar, in theory, an American could, or European for that matter, could look at Argentina. I've been to Argentina many times. It's one of the most beautiful countries in the world, and nice people, great restaurants. So, but it could look kind of like a bargain to somebody with a very strong currency.
Sure.
But that's not really Argentina's problem. Argentina needs more high-tech industry, more high-value added industry. It needs to break out of what's called the middle income trap, where you get to a certain point, but you can't get past that point because you can't just do it with assembly style manufacturing jobs. You need high value added jobs. You need technology is what you need. And all the developed economies are facing the same issue.
That applies to all of Latin America, Chile, Mexico, Colombia.
Correct, but it applies to most of Asia as well. This is China's problem. China's not going to continue the kind of growth we've seen over the last 20 years because they've used up that. When I studied development economics in the 1970s in graduate school, and we used to think that the hard part of development economics was getting from low income to middle income. And then we say, if you get to middle income, it's a straight path to high income. Turns out that's not true. Getting from low income to middle income is actually pretty straightforward. You have to get rid of corruption and you need to ease up on regulation. But you can, if you have foreign direct investment and people come from the country to the cities and you do, kind of simple manufacturing, et cetera, you can get a really good export machine going and earn hard currency reserves. So that part's easy. The hard part is getting from middle income to high income, because it turns out you can't just do more of the same. You actually need more high value added. You need technology today, and that's what I would advise every country to be working on, including Argentina, where the Argentina has a very highly educated workforce. I mean, Argentina would be a good case to why don't we make iPhones in Argentina instead of China, and we're going to bust up. The United States is going to bust up the supply chain to China. We're going to shut over time. Won't happen overnight, but we're going to pull those factories out or shut them down and move them elsewhere. So the question is, if I were advising any developing economy, I would say, how can I become a supplier to the United States? If they're going to get rid of China, which we are for a lot of reasons, I'd want to be in the list. And we're actually looking at Jordan as a country that could make cell phones. India is a big case because they have cheap labor. Argentina, I think, is a better candidate because they have a more highly educated workforce. Yeah, I'm very bearish on Chinese companies. And when you mention delisting, it is true that the United States is putting some pressure on Chinese companies to improve their disclosure. Now, I would say they never should have received exemptions in the first place. But leaving that aside, we're now at the stage where the U.S. is requiring them to disclose more, higher disclosure standards, more similar to what U.S. companies themselves have to do. But there's also a move to delist that's not coming from the United States, it's coming from China. The Chinese, remember, they're not driven by the market, they're driven by the Communist Party. The Communist Party is actually fearful of the power of some of these Chinese oligarchs and Chinese companies. We know all the big names, Tencent, Alibaba, and many others. And so the Chinese are saying, well, you have to delist from New York and list in Hong Kong Stock Exchange, because Hong Kong is now, their independence is gone, their freedom is gone, they're completely under the thumb of the communists. So, so you're seeing pressure from both sides. The U.S. is sort of pushing them out because they don't meet the disclosure standards, but China's saying you have to get out and come to Hong Kong. So it's all part of the bigger trend, which is the decoupling of the U.S. and Chinese economies. It won't happen overnight. It's a multi-year process, but it is underway. And I would say on the U.S. side, it's driven by national security, and on the Chinese side, it's driven by a desire to maintain the Communist Party control. So, but that aside, even if you took the Chinese companies independently, leaving aside the delisting issue, which we just discussed, the outlook for China is extremely negative. And demographically, they're going to have the greatest demographic calamity or collapse in the history of the world. They're going to lose 600 million people over the next 40 years. That's their population is aging. The one-child policy has been extremely damaging. 20 million or more girls were killed at birth. And even today, even though they relaxed the one-child policy officially, no one cares. People say, well, we're not getting married. We want education. We want to go to the cities. Marriage rates are down. Birth rates are way down. The replacement rate for any population is 2.1, meaning each couple or each childbearing woman has to have 2.1 children in order to maintain. That's just to maintain the population constant. If you're below 2.1, your population is shrinking. China may be as low as 1. That's catastrophic. That's not a small difference. That's a huge difference. It'll cut the population in half within 2 generations. So a lot of their technology is stolen, so that's been cut off. They cannot steal as much technology as they used to. Their population is aging, and the productivity of older people goes down. Aging is highly correlated with dementia, Parkinson's disease, Alzheimer's disease. A lot of people are going to be devoted to the care of the elderly, which is a worthy thing to do, but it's not. Giving people a bath hasn't changed in 5,000 years. That's not an occupation that lends itself to productivity gains. So, and China has no natural resources, or at least very few. So demographically, industrially, quality point of view, and financially and otherwise, China is going to go into a very steep long-term decline. You should never follow Wall Street recommendations because they actually don't care about you. They only care about themselves. Common sense plays a role. There are independent financial advisors who can help people who are not, in the brokerage industry per se. There are some good economists, not very many necessarily, but there are some good ones. But what I would say is, and I'm more of a macro analyst than a technician, but we have completed what technical analysts know as a head and shoulders formation. So head and shoulders is, the stock market goes up and it goes down a little bit. Then it goes up to all-time highs, and then it goes down, and it goes up again, but it doesn't get as high as the time before. So it's here, higher, and then back up, but not as high. And then it goes down a lot. If you look at a chart, we've completed the head and shoulders formation. So we're now in a pattern of a downtrend, lower highs and lower lows. That's just the trend. That's how bear markets look. But it's more dangerous than that. It's more vulnerable than that for the reasons we talked about earlier, which are supply chain sourcing, the impact of the war, humanitarian crises, transportation, logistics disruptions, higher interest rates, many other factors, Chinese shutdowns, etc. So I would expect that decline to accelerate. So we're in a downtrend. Nothing goes in a straight line. It doesn't go straight down. There'll be up days and down days, but the trend is downward, which doesn't mean you can't be in stocks, but you just have to be very selective. And above all, I would recommend allocations to other types of assets. So I would include cash, land, gold. If you're in the stock market, energy stocks, I think will do well. And really just construct a portfolio with things that are not correlated to each other. I see people who they say I'm highly diversified. I have 50 stocks in 10 different sectors. And I say to them, you're not diversified. You may have 50 stocks, but you have one asset class called stocks, and they will all go down together. So get some other asset classes, including, as I say, natural resources, gold, cash, land, farmland, and some other sectors. Well, it's always gradual at first and then sudden. So right now we're still in the gradual stage, but watch, I wouldn't expect a sharp downturn until maybe late this year, early next year, meaning late 2022, early 2023, because the Fed is raising rates, but they're kind of doing it slowly. The supply chain is breaking down, but it also doesn't all break down at once. The impact of the sanctions takes a while to kick in. So all the factors that we've discussed will have a very negative impact on stocks, but not right away. It'll be a downtrend, but I would expect perhaps a more severe turn of events in the fall, maybe October.
In conclusion, there have been multiple and overlapping negative factors this year: inflation, rising interest rates, and geopolitical crisis. What advice would you give to investors in the current situation?
Number one advice is diversification, which we just talked about. So have some stocks, have some cash, natural resources, gold, real estate, farmland, maybe some treasury notes, because we remember if the economy really collapses, we could have deflation instead of inflation, and you want to be ready for that. So number one, diversification. Number two, have some liquidity, have a larger than normal allocation to cash, maybe even 30%, because you won't get hurt in a downturn. And when the downturn comes, you'll be able to go out and buy some bargains. Other people will be stuck in losing positions or things they can't get out of, but the person with cash can go around and buy up things at a deep discount. By the way, the number one person in the world who's good at what I just described is Warren Buffett. Warren Buffett has record amounts of cash because he can see this coming also.
Let's talk about investment. You suggested buying gold in an interview last year. When gold prices bottom out, investors who followed your advice should make an 18% profit. Is it worth investing in gold at this point?
Just to take a really simple example, let's say that there was, the bar of gold in front of us, and I wanted to sell it to you, you wanted to buy it. We would go back and forth over the price. We'd agree on a price, and we'd sell that bar. But what if we had one bar of gold, and just make up, let's say a 1 ounce gold coin, so $1,400. And I said, okay, Lynette, I could sell you the 1 ounce gold coin for $1,400, but why don't I sell you 100 ounces. I only have 1 ounce sitting here, but we'll make the other 99 a paper contract. And we'll agree that either I pay you or you pay me, depending on where the price goes from here. So bear in mind, we only have 1 ounce of physical gold, but we do a deal on 100 ounces, 99 ounces of paper gold and 1 ounce of physical gold. Well, that's a much bigger deal, a lot more money involved, a lot more profit and loss for either one of us. But there's still only 1 ounce of gold. The other 99 is the derivative. So a derivative is just a paper bet. It's a paper bet based on some underlying with no limit as to how big the paper bet can be. Now, I'll give you another concrete example. And I remember in 2007, when the mortgage crisis first hit in the spring, and then there was a money market crisis in August, and that's when Jim Cramer had his famous meltdown with Aaron Burnett on CNBC. They know nothing, but the point being, that was the beginning, and then it came to a head over a year later with Lehman Brothers in September 2018. But when it first started, there were some very smart people, and I would put, Ben Stein and others. He's an economist, and he's a comedian, actor, but also an economist. And a lot of other people said, look, there are $1 trillion of subprime mortgages, and that's about what there was with Alt-A. That's another kind of subprime, but let's say $1 trillion of subprime mortgages. In the mortgage market, 5% is a huge default rate. When default rates get to 5%, people are, kind of panicking. He said, let's get crazy. Let's assume a 20% default rate. It never got that high, but just assume it. Well, 20% of 1 trillion is 200 billion. So he said, even if this thing gets totally out of control, we'll have 200 billion in losses, which was about the same in real terms as the S&L crisis of the 1980s. That was about 135 billion of losses. So adjusted for inflation, it would be $200 billion by 2007. And Stein said, well, we survived the 1980s. We can survive this. It's about the same. What he was missing was that, there were $1 trillion of mortgages, but there were $6 trillion of derivatives on the mortgages, on the same mortgages. And so 20% default rate, it wasn't 200 billion, it was 1.2 trillion of losses just to get started. And then the panic went on from there, and the losses were ultimately in the scores of trillions.
Right.
But the point being, you cannot look at bank balance sheets. You cannot look at futures contracts. You cannot look at any known quantity and understand the risk without understanding how much is off balance sheet, how much more of the same thing, the same kind of bet. And banks do not put derivatives on their balance sheet. And I've had this debate in chapter 8 of the book, chapter 8 of Aftermath. I talk about a private briefing that I had with the board of directors of Morgan Stanley and their CEO, James Gorman. And I said, well, first of all, a couple things. Number one, your derivative book might be smaller, it actually was, but that's because so many of the derivatives were moved over to the clearinghouses. They created these clearinghouses after 2008. So now, two banks do a derivative trade, and they take it and they send it to the clearinghouse, and you put it on the balance sheet of the clearinghouse. You didn't make the risk go away. You just moved it to a side pocket. So maybe Morgan Stanley or Citibank's balance sheet has fewer derivatives, but it doesn't mean there are fewer derivatives in the system. They've just been put over in the clearinghouse. Who's going to guarantee the clearinghouse? Again, Morgan Stanley's capital base may be fine, at least in most circumstances, but who's backing up the clearinghouse? Well, the answer is the members, which are the banks. So if the clearinghouse gets in distress, they're going to turn to their members and say, hey, give us capital, at a time when the banks are like, oh, we can't do that because we need all the capital we can get. So first of all, you're undercounting derivatives when you ignore the clearinghouses, number one. Number two, and this was the point I made, I said, look, as a bank, you may be stronger, but you're part of a system, and the system is more vulnerable. And if the system goes down, you go down with it. I don't care how strong your balance sheet is. You're part of something bigger, and if that collapses, you collapse too. And I said, look, you're running a bank. You can't take responsibility for the whole world. That, in theory, is the responsibility of regulators and central bankers and others. But they don't know any more about risk than Wall Street does. I mean, everyone's ignoring the risks or not computing the risk properly. So I say, maybe your bank's more sound, but you're not counting the clearinghouse and you're ignoring systemic risk, which is bigger and more dangerous than ever. The warning signs are all over the place. You just have to understand them, incorporate them, connect the dots, and then see how it plays out. And it's not just one path or multiple paths, but they all sort of end up in the same place. And then I bring it full circle. I say, well, if this is coming, and it is, what are you waiting for? Why not? Why not get ready now? When I've had people say, I'll be half facetious, but it's kind of true. They say, Jim, I hear you, I agree with you, but I'm making too much money in the stock market. Could you call me at 3:00 the day before the crash, and I'll sell my stocks and buy some gold? And I said, well, first of all, I'm not going to know the day. I can tell you it's coming, but I don't know the day. And if I did, I'd probably be a little busy myself. But the point is, when you most want your gold, when the panic hits and everyone like, get me out of stocks, get me out of money market funds, I want gold, you're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Right. It is, because there's, you were talking earlier about people selling their stocks and their money markets and all of these and buying gold before the crisis hits. But will there be any buyers on the other side of any of these assets?
Well, that's right. And this is what I talk. That's correct. Now, this is what I talk about in chapter 4 of the book, how more and more assets under management have moved to passive investment styles.
Yes.
That means index funds and ETFs and things like that. Well, when passive investing started, when it began, I analogize it to like a mosquito lands on the back of an elephant. Well, the mosquito has a good time and the elephant doesn't even notice. So passive index funds were basically piggybacking on active investors who were committing capital, taking risk, and making markets, engaging in price discovery. And you could just kind of go along for the ride. But what happens when it's not one mosquito, it's a billion mosquitoes? The answer is the elephant dies. And that's what's happening in markets. More and more funds are going passive. Fewer and fewer are going active. Well, the active investors are the ones who commit capital and make markets. So you get into a financial panic where the passive investors, their investors want their money back. So they have to sell stocks or sell assets or sell bonds to get money to pay the redemptions. Well, where are the buyers? You've driven the active managers out of business. They're not going to be heroes like firemen rushing to a fire. They're going to walk away. And so the market's going to go no bid and it's going to go straight down. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. In the last 5 months, it's gone from, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are 2 different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates, They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own, and that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms, and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won. Because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. Wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, in Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, a flashing light, whatever you want to call it. Interest rates are a lagging indicator. everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. Inventories are sky high and new orders are being slashed. You're not moving anything by truck. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. Less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the key word. It's not, if stocks are going down, but it's kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because There's bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions, like '08, like '01?
The answer is yes. First of all, we're seeing it already. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6. I don't know the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%, so your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right, you're in the military. Yeah.
You're in the, there's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment.